Okay. So to start off, I just gave an introduction about monetary policy. So basically, the monetary policy is a policy by which the objectives of the monetary policy will be something which will be determined depending upon the provisions that are there in the Act and also the requirements of the economy. Generally, monetary policy is understood as a policy which is going to influence the amount of money in circulation. Second aspect of monetary policy is that it's a policy which would influence the amount of and availability of and the cost of credit. So basically, money is the thing which can enable you to buy goods and services. The second thing is you can take credit and then you can buy goods and services. So the price of commodities is basically dependent upon the demand and supply. And the third element that operates in relation to the setting of price is not demand and supply, but the money that is going to buy or the credit that is going to buy. And the RBI has no great role to play in terms of influencing the demand, except in terms of influencing the demand of credit. RBI does not have a great role to play in terms of providing supply, except in providing the mandate through priority sector lending norms. So from that point of view, RBI has no control over the price in the real sense. But RBI's control and its influence comes only in terms of moderating the availability of money so that too much money does not chase too few goods, resulting in inflation. Then there is not a crunch in terms of money because it becomes pricey at that point of time and people will not have the right amount of money to go and do their purchases. So moderating the quantity of money is one of the important aspects. And the second part of it is making available credit and ensuring that the availability of credit and the cost of credit are moderated so that the amount of credit and the cost of credit is influenced by Reserve Bank of India. And over a period of several years, ever since Reserve Bank has been set up, the objectives of monetary policy were not very clearly laid down. If you see the preamble of the Reserve Bank of India, its act, it says the objective of Reserve Bank of India is to regulate the issue of banknotes, which is basically one of the monetary policy functions. The second part of it is to regulate the keeping of reserves with a view to securing monetary stability. And when you talk about monetary stability, there are two dimensions to it. One is an internal stability, which is price stability, or keeping inflation in check. The second stability that we are talking about is an exchange rate stability, which is something which RBI operates in the foreign exchange market space, which I think I have discussed in the previous session. So monetary policy is basically having those two mandates. Then subsequently what happened is we became independent and then we wanted the planned development to happen. So one of the policy objectives was to enable credit availability to all sections of the people. Then 1975 onwards, we created something called as a priority sector and then prioritizing availability of credit to certain areas. Then it so happened in 1997 that the East Asian market crisis were there. So regulating the markets and the payment and settlement systems became a very important objective of the monetary policy. Then ensuring financial stability also became one of the objectives of monetary policy. So from the basic concept of enabling price stability to focusing on growth, then to enable targeted lending to important sectors, then to keep the exchange rate stable, then to enable financial stability. All these objectives were the objectives which were there for RBI. And internationally, after the global financial crisis, it was decided that the central bank should have a mandate, basically a limited mandate to deal with inflation, whichever way you decide. And it should not be the Reserve Bank only which will be dealing with the decision making, but there has to be a committee approach for deciding the objective and setting the path for Reserve Bank. But within the path that has been set, Reserve Bank should be free in terms of implementing the tools for enabling the objectives to be met. So when this philosophy took shape, the Reserve Bank of India Act was amended in 2016 and the new monetary policy framework was brought in, where clarity was brought in terms of what should be the monetary policy objective, what should be the operational tool for monetary policy, and then what should be the institutional mechanism for arriving at this tool, and what are the other reporting mechanisms, transparency, accountability framework, etc. So all that in relation to monetary policy is contained in chapter 3F. So RBI is the monetary policy authority of the country. That has also been expressly indicated in the preamble. The objective of monetary policy has been specified that it is price stability, keeping in mind growth. Now, how do you define price stability? They have indicated that the system that we have is something called as an inflation targeting mechanism. So here, the targeted level of inflation to be managed through the monetary policy operation is something which is decided. And who decides it? It's the central government in consultation with Reserve Bank, which will decide. And based on that decision of what is the inflation target, RBI has to moderate its policy rate. And who decides the policy rate? It is not the Reserve Bank of India's governor and its management. Now there is a body which has been set up, which is a 6-member committee called the Monetary Policy Committee, which has 3 members from RBI and 3 members from central government, who are appointed by central government, who will be sitting and deciding the policy rate. Once the policy rate is determined, RBI will be free in terms of using the various tools that are there in its kitty for the purpose of achieving the inflation target and keeping that the inflation is kept within the limits that are set by the government. So this is the framework of monetary policy that is available. So now let us just see what are the various tools. And generally the question that is asked is what is the role of Reserve Bank of India in relation to monetary policy? Then what are the tools that are available with Reserve Bank of India for credit policy? So the tools are basically similar. You don't need to be worrying about the difference between credit policy and monetary policy. You can list out the whole tools and the way in which they operate, and that should be sufficient. So here, what are the tools that Reserve Bank has in its basket for operation are: first is cash reserve ratio. So this is a amount of money that is supposed to be kept in a current account balance with Reserve Bank of India in case of scheduled banks under section 42 of the Reserve Bank of India Act. Then in case of non-scheduled banks under section 18 of the Banking Regulation Act, the banks are supposed to be, non-scheduled banks are supposed to be maintaining balances either in their own account or in an account with the net balances with the other scheduled banks or other banks. So those mechanisms of holding of either cash or bank balance with itself or balances with other banks, that is the mode of holding of cash reserve ratio. In case of scheduled banks, it's only a current account balance with Reserve Bank of India. The second tool that is there is the statutory liquidity ratio. That is under section 24 of the Banking Regulation Act, the banks are supposed to be investing and keeping invested in government securities a percentage that is notified by Reserve Bank of India. As far as cash reserve ratio is concerned, this also will be notified by Reserve Bank of India. The present rate of cash reserve ratio is 4.5% of net demand and time liabilities. In case of statutory liquidity ratio, the amount that is specified or notified by Reserve Bank of India is 18% of the net demand and time liabilities. Then, how does this operate? Let me just talk about the tools in relation to 2 balance sheets. One, let us look at what is the balance sheet of the bank. And the bank's balance sheet is important for us to understand how the CRR and SLR are operated, how the repo, reverse repo, then open market operations, etc. are operated. So first, what are the liabilities of banks? The most important liability of the bank is deposits from public. Then they could have non-resident deposits also. So that is the second kind of liability. Then whatever money they are borrowing from Reserve Bank of India, and what would be the need for a bank to borrow money from Reserve Bank of India? Because it would want to expand its lending operations, or it could be finding it difficult for it to manage its liquidity position, in which case it will go and before it mobilizes the money from other sources, it will be taking a temporary accommodation from Reserve Bank of India, or it could be a loan from Reserve Bank of India. So the provisions under which the loans can be given, the provisions under which finance can be provided are all there in section 17 of the Reserve Bank of India Act. So borrowing from Reserve Bank will be one part. Then the other mechanism of borrowing is borrowing from the market. It could borrow from other banks who have surplus liquidity. It could borrow from other institutions like LIC or other kinds of institutions. So borrowings could be from those sources. Then borrowings could be from other sources also, like certificate of deposits, etc., which can be subscribed by others. So these are all the liabilities that are there. Then what are the assets of the banks? The most important asset is balances with Reserve Bank of India, which is cash reserve ratio. Then the second important asset is government securities, a portion of which is mandatorily supposed to be maintained under section 24 of the Banking Regulation Act as a part of the SLR. But it is not, most of the banks don't restrict their securities holding to merely 18% that is specified. For various compulsions or for the safety's sake, they will be investing in government securities. So government securities form an important portfolio for the bank's investments. Then whatever loans and advances are extended by the banks, that will be another asset. Then other investments other than government securities which they are investing in, that will be also the assets of the bank. Then foreign exchange loans, export credit, etc., that is provided for, these also constitute to be assets of the banks. So now, how will the lendable resource of the bank be affected? So if I am going to increase the CRR, automatically the amount of balance that is supposed to be kept with Reserve Bank of India will be more, and the amount of money that is available for lending of a bank will be reduced. So similarly, in case of SLR, if I am going to increase the SLR requirement, automatically the amount of money that can be lent by a bank will be reduced. So where there is a surplus liquidity that is available, Reserve Bank of India would be influencing the amount of lending resources of the banks by either increasing the SLR or increasing the CRR. Second thing they would do, where the system is there, the liquidity shortage would be there, then they would be reducing the SLR and reducing the CRR. So imagine that presently we have 4%, 4.5% and 18%. So tomorrow it feels that there is a need for more lendable resources from the banks, so that the liquidity has to be increased. Then they will reduce the CRR from 4.5 to 4% or SLR from 18% to say 15%. So this kind of change that they are doing will influence the amount of lendable resources of a bank. So this is how the monetary policy tool of CRR and SLR will operate. Now coming to the next tool, that is repo rate and reverse repo rate. What is repo and what is reverse repo? So where the bank finds that temporarily now it is not in a position to meet the liquidity requirement. So at the end of the day, if the bank is not in a position to meet its CRR balance with the Reserve Bank of India, then it will have to square up the position by going and mobilizing money. So where does it raise the money from? It can raise the money from the call money market, which is an open overnight market, or it can go and raise money from Reserve Bank of India. So the rate at which Reserve Bank gives money to a bank, but it does not give the money free. It takes government securities as the collateral, and against that it gives the money to a particular bank, and with an agreement that tomorrow you give back the securities, and then you pay back the money and take back the securities. So this transaction where there is already an agreement to repurchase, which is intended for temporary financial accommodation to be provided with the collateral of government securities or other instruments that RBI specifies. That is what is called as the repo. And the rate at which the finance is provided by Reserve Bank of India is what is called as the repo rate. And this repo rate is the policy rate which RBI's Monetary Policy Committee will specify. So if liquidity is supposed to be provided to if the banks find it difficult to raise money from the market, they will raise money from the Reserve Bank of India. Now, what is the rate at which presently RBI provides financial accommodation under the repo window is 4.9%. So, ideally, if a bank is able to mobilize money from any other source at a price less than 4.9%, then it will try to do it from there. But where it cannot mobilize from anyone else, then they will mobilize the money at the repo rate. Yes. So now this repo rate is a mechanism by which the rate at which RBI will lend. So now what is the other impact of this repo rate is any loan that is given by the bank, the rate at which it is receiving money is now say 4.9%. So depending upon the credit worthiness of the person, it will mark up the rate and provide the loan at that particular rate. So what will be the impact of repo is, one, if there is a repo, it is a mechanism for ensuring that money is put into circulation by taking the securities from the bank. So this will be one impact. Then by influencing the repo rate, what does RBI do is the rates at which banks lend also get adjusted. So whenever the repo rate is increased, like what was done in the previous two monetary policy cycles, automatically the banks will increase their lending rates. So the moment the lending rates are increased, automatically the loans become costlier for the customers. And when the loans become costlier, they will try not to borrow. And when they don't try to borrow, then automatically the liquidity condition will come to be normal. So repo rate has two implications. One, in terms of providing financial accommodation, and the second in terms of providing the benchmark rate for other instruments to be priced, and also the benchmark rate for the bank's own lending to be priced. So this is as far as the repo is concerned. But for someone to be using the repo facility, they have to be having surplus securities. And what is this surplus securities? Government securities which are more than the SLR limit that is specified. So if someone is going to have 20% of government securities of demand, the SLR limit is 18%. So for the 2%, if they are finding it that they need to borrow, they can use the excess securities that they have, and they will take money from Reserve Bank of India. So if they don't have this excess securities, then what is the process? If they want to take money from Reserve Bank of India only. So RBI provides a facility which is now called as the marginal standing facility. So here, what does RBI do? A particular percentage of the SLR securities. Against those securities, RBI permits them to borrow money from it on the same mechanism as a repo operates. So here, because you are not complying with the requirement of SLR, but you are availing of an additional facility, the rate of marginal standing facility will be higher than the repo rate. So now presently, what is the rate that is there for marginal standing facility is 5.15%, which is where the repo rate is 4.9%, marginal standing facility rate is 5.15%. And the rate at which RBI rediscounts eligible bills of exchange, which is notified by Reserve Bank of India under section 49 of the Reserve Bank of India Act, is what is called as the bank rate. So now bank rate is now no more operational because we are all in the short-term interest cycle only. Our interest is more in the short term rather than the long term. So earlier, when you had a long-term perspective to interest rates, bank rate was the rate which was influencing the long-term lending rates. So the rate of the marginal standing facility is now the bank rate. That is, bank rate is also at 5.15%. So now imagine that the liquidity requirement is not of a nature that today I am getting this liquidity and tomorrow it is going to be normal. Where there is a short-term liquidity crunch or short-term excess liquidity, the facility of repo and marginal standing facility will be used. But where you find that the liquidity shortage is continuing for a long time and you don't want to do this business of giving money today and taking back the security, taking securities and reversing this transaction tomorrow, and keep continuing this transaction for every day, where you don't want to do that kind of a transaction. The tool that Reserve Bank of India uses to provide liquidity is something called as outright purchase of securities. And what happens in an outside purchase of security is the government securities balances of the bank will come down and Reserve Bank of India will provide money to the bank. So this kind of a transaction where in case of a repo also the same thing, government securities are given to Reserve Bank and money is given by Reserve Bank of India to the concerned bank. But there is a repurchase agreement that tomorrow you will have to reverse the transaction, or if it is a 14-day repo, after 14 days, if it is a long-term repo, after the period, the transaction has to be invariably reversed. That's why it is called repo. Here there is no repurchase, because of which it is called as an outright purchase transaction. So outright purchase and outright sale of government securities for dealing with liquidity surpluses or shortages over a longer period of time is what is together called as open market operations. Now imagine a situation where the bank is having surplus liquidity. In that case, if this surplus money that is available with the bank is going to be continuing, then automatically it will have an implication on inflation, because too much money will be there in circulation. So the mechanism that will be there will be that they will try to give it to other institutions who are interested in borrowing money. So they will offer it to the market. Now everyone is having surplus money, so nobody will want to take money from a bank. So Reserve Bank of India provides them with an option where they could give this money and RBI will issue the securities to the bank with an agreement to buy back the securities. So this transaction, which is a reverse of what repo is what is called as a reverse repo transaction. That is, in a repo transaction, RBI gives money, bank gives securities. After the period is over, the transaction is reversed, where there is an agreement at the date when you are entering into the transaction to reverse the transaction. But where in case of a reverse repo, the bank is having surplus money and Reserve Bank of India will take this surplus money and give the securities to the bank with an agreement to reverse the transaction after the particular period of time. So this transaction where the surplus liquidity in the market is absorbed by Reserve Bank of India through the collateral of securities with a repo transaction is what is called as reverse repo. So the rate of reverse repo will be, it is just like in any other market rate. So you receive money for less, and when you pay, you are paying more. So here Reserve Bank of India, when it is taking money, it will offer a rate which presently is 3.35% for fixed reverse repo rate. So 3.35% is the money which they will be assured. So they will keep with Reserve Bank of India and then take back the money. Now similar is the case where this kind of surplus liquidity in a bank is continuing, and it is not something which is temporary in nature. We don't want a system where we are going to take in and reverse on a day-to-day basis. So here the RBI conducts another kind of open market operation, which is called as an outright sale. That is, they will sell the security to the bank and take the money from them with no agreement to reverse this particular transaction. So the facility that is provided here, or the monetary policy tool that is operated here, is what is called as an open market operation. So in open market operation, you could have outright purchase and outright sale depending upon. So where the liquidity is in surplus in the market, you do an outright sale of transaction of securities. You release the securities to the market and mop up the money. Where there is liquidity shortage, you take the securities from the market and provide money to the banks. So this mechanism of influencing the availability of money and availability of lendable resources to bank is the operation of credit policy or operation of the monetary policy. So now we have seen this mechanism where temporary liquidity is adjusted through the repo and reverse repo is what is called as the liquidity adjustment facility. The facility by which money is provided where you don't have surplus securities, but you are going to use the collateral of securities within the SLR up to say, I think now it is 2%, it is permitted. So that 2% securities of SLR, if you are using and you are taking money from Reserve Bank of India, that facility is called as marginal standing facility, where the liquidity excess and surplus and shortage is for a longer period of time. Instead of doing this repo and reverse repo, you do something called as open market operations of outright sale and purchase of securities. Now, with the recent monetary policy, RBI incorporated a new tool in the monetary policy operation, which is called as standing deposit facility. One of the important problems that is there with the Reserve Bank of India's Act is we made an amendment saying that Reserve Bank of India is not supposed to receive money in deposits and pay interest for it. So whenever RBI is in need of operating the monetary policy, the problem will be in terms of the volume of securities that Reserve Bank of India has. So the volume of securities with Reserve Bank of India was high in 1997 because we did the direct monetization and converted all those securities into government securities. So, but afterwards, after 2003, RBI was not permitted to directly go to the market and purchase government securities. So from that point of view, the stock of government securities that Reserve Bank of India had kept on dwindling. So now we need a tool where it should not be necessary for Reserve Bank of India to keep issuing securities and reversing it or doing that. So why not have a tool where the bank will be keeping the surplus liquidity in a deposit with Reserve Bank of India, not like CRR, but something more than CRR. And this tool will be used for the operation of monetary policy and for moderating the amount of liquidity with banks. So with that objective in mind, RBI introduced a new monetary policy tool called the standing deposit facility, and it amended the act to facilitate RBI to pay interest on the deposits which are kept with it. So presently what is the standard deposit facility rate is 4.65. So now you can see if someone wants to raise money from the market and they cannot raise from anywhere else, they will approach Reserve Bank of India and take it at the repo rate, which is 4.9%. Second, if they have surplus money with them and nobody is in need of money, then they will come and deposit with Reserve Bank of India and they will earn a rate of interest of 4.65. So if everything is fine, the market demand and supply and the rate of the money being transacted in the market on an overnight basis should not be anything more than 4.9 or anything less than 4.6. So this band between 4.65 and 4.9 is what is called as the corridor. And the call money market rates are supposed to be operating or hovering around this corridor. So ensuring that, and once the rates are operating within this, automatically there will not be surplus liquidity and there will not be surplus availability of credit. So indirectly, this will have an implication on the prices of goods and services, and the inflation level also will be getting in tune with this rate that is being operated by the Reserve Bank of India. So this is how the monetary policy operates. Then the other important aspect which has monetary policy implication is the incoming of foreign exchange and outgoing of foreign exchange. So where there is a fluctuation in the foreign exchange, automatically suppose foreign exchange is coming into the country, then there is an excess of foreign currency. Unless there are foreign currency loans to be taken, this money that is available with the bank will be in surplus. So when you have surplus foreign exchange, the price of the dollar will depreciate and your exporters will have a problem. So to enable the exchange rate to be stable, RBI will mop up this excess foreign exchange and then build its reserves. But RBI, while it is buying this foreign exchange, it is going to release rupees also. Now the rupee liquidity will be more. So now rupee liquidity will be more, again that has inflationary implications. So RBI will have to mobilize these rupees again back. So this mechanism where because of the huge amount of foreign exchange inflows, there is a problem in terms of the rupee liquidity also coming up, and the mechanism of sterilizing this rupee liquidity is what is called as sterilization. And how does RBI do this? RBI, in after an agreement with central government, has issued certain special securities called the market stabilization scheme securities, which will be used for mopping up this surplus liquidity. So tomorrow when these foreign exchange balances have to be paid up and the cycle reverses, then first thing that will happen is the market stabilization securities will be cleared. They will be sold. Then you will have rupees coming in, and then these rupees will be used for purchasing dollars. So automatically RBI's foreign exchange reserves will come down. So the monetary policy has a very important relationship with the foreign exchange rate management also. So the other important tool that is used for the purpose of monetary policy operation is something which is called as the market stabilization scheme. So we have seen cash reserve ratio, we have seen statutory liquidity ratio, we have seen the repo rate, which is the policy rate, then reverse repo rate, then repo and reverse repo if it is for a short term overnight kind of a facility that you're dealing with, or up to 14 days. So that kind of facility is what is called as a liquidity adjustment facility. So both these are collateralized by government securities. Then if you don't have sufficient government securities, then you are taking a portion of your SLR, and against that security you are taking money from Reserve Bank of India. That is called as marginal standing facility. There is surplus money available with you. You are keeping this balance with Reserve Bank of India under the standing facility scheme. Then standing deposit facility scheme, then it's a other monetary policy tool that is there. Then where the liquidity surplus or shortage is for a longer period of time, instead of doing this repurchase, etc., RBI will either directly sell or directly purchase the securities. This outright sale and outright purchase of securities is what is called as the open market operations. Then where there is foreign exchange inflows which are more, to balance that inflows and to sterilize those surplus and the liquidity of rupees resulting therefrom, RBI operates the market stabilization scheme. Then another important mechanism that has been adopted by RBI is something called as dollar rupee buy or sell swap. So here, where there is huge amount of foreign exchange coming in, then automatically RBI will take this and convert this into rupee. And similarly, when the need comes, the transaction is reversed. So this is an easier mechanism to operate when compared to the market stabilization scheme. So RBI introduced this tool about 1 or 2 years ago. So these are all the various monetary policy tools that are available with Reserve Bank of India to influence the amount of credit. So as I told you, repo rate, reverse repo rate, bank rate, and these rates also influence the money market rates. These rates influence the government securities market rate. These rates influence the foreign exchange rate, and these rates influence the rates at which banks are lending to customers, either domestic or international. So the implications of any change in the policy rates will be on the interest rates across the system. So that way, the cost of credit will be influenced by Reserve Bank of India's monetary policy operation. The availability of credit and banks' lendable resources will be influenced by Reserve Bank's monetary policy tools. Then the other important tools that are there with Reserve Bank of India is something called as selective credit control. So under section 20 and 21 of the Banking Regulation Act, RBI has ability to give directions relating to the credit loans and advances that are made. So using those, RBI issues directions under the selective credit control. Suppose there is a commodity where there is a huge price fluctuation and there is a demand at that point of time, but you may sense that the bank, they are going to not release this stock into the market. Example, sugar, etc. There used to be a control. So if you are not going to provide credit for the person who is producing sugar, then automatically he will release his surplus to the market because he will have to get back money. So now, if a bank gives credit for sugar, then automatically what will happen is he will hoard the sugar and the price will jack up because there is no adequate supply of sugar. So through the selective credit control, RBI used to give directions in relation to sensitive commodities, saying that you are not supposed to be giving loans for this, or they will indicate that the margin of the loan should be say 50%. Then the rate of interest can be influenced. So through this mechanism, you are ensuring that the supplies of important commodities continue to be there. Then the other prudential mechanisms is your what is it? Risk-weighted assets. So wherever suppose there is a real estate lending which is going on in a very brisk way. So and RBI feels that there is too much of lending by banks to real estate. So then what they will do is they will increase the risk weight for real estate from 100 to say 125. So when the risk weight is increased, correspondingly they have to maintain a higher amount of capital because the requirement of RBI is 9% capital to risk weighted assets ratio. So now because of my increase in risk weight, the amount of capital that I have to maintain to meet the CRAR requirement has to be high. So since they can't mobilize capital immediately, what they will do is to start reducing the amount of lending to real estate. So this is a prudential measure through which RBI influences the direction where credit is supposed to be given, the quantum of credit, etc. Then the last and most important tool that is there is moral suasion. Moral suasion.
Professor Mallikarjun, can
Yes,
I
sir.
just, if I can take a minute?
Yes,
If you could just explain, how does Section 20 of the Banking Regulation Act correspond to what you were saying? I missed that.
yes. Section 20 and 21 of the Reserve Bank of India, of the Banking Regulation Act, gives power to Reserve Bank of India to give directions relating to lending of banks. One, in terms of how much they can lend, what margin they should be lending against, for what purposes they should lend, etc. So imagine that there is onion, sugar, and other things. They are having a potential that if the market is flooded with these, automatically when the production is over and you are going to release the supplies into the market, so the continuous supply of these will be there. So there will not be a hike in price. So now, how will the price hike happen is when I am going to store this and I am not going to release it into the market. And because so many people are not releasing it into the market, automatically there is a greater demand but no supply. So if I am a normal person who is doing my own business, I would release it into the market because I would want to get back the money. If I am getting a credit for my production, and if I am going to be given credit by the bank so that I don't need to immediately sell it to the market, then what I will do is I will not release it to the market, but I will hold on the stocks. So the prices will keep increasing. So RBI gives a direction saying that if to banks by saying that if you are going to be lending for sugar, kapas, and maybe an oil seed or something like that, cotton or something like that, then the bank should be giving at a 50% margin. That is, if I am going to give 100 rupees loan, 50 rupees I should bring from myself. So the loan component will be only 50%. So that is where will be the incentive for me to keep holding it on. So I will have to get 50%. So automatically the tendency would be to let go the stock so that I get some money at least. Then the bank could be indicating that the rate of interest for this particular loan will be say 25% or 30%. So instead of bearing the cost of that, I could release the goods into the market. So what is RBI doing here is influencing the lending by banks to these particular commodities, and then through the influencing of the holding of these stock, it is going to determine the price. So that mechanism that RBI adopts through instructions relating to the lending for specific commodities is what is called as selective credit control. Of course, this is now no more in vogue, but this was one of the important tools that was there with Reserve Bank of India. Then at one point of time, we also had a totally regulated interest rate regime where RBI used to specify just about every rate that was there in the market. So that was also one of the mechanisms by which we used to control the cost of credit. So I hope I'm clear now.
Very, very clear. I think this is basically to influence or to
Prevent
curtail
hoarding.
the unnecessary influence on the price elasticity of demand for the commodities.
Yes. The second important part is a prudential measure, because you don't want all the eggs to be put in one basket. So what you do is you sense that there is an overheating in the real estate market because everyone is trying to play into the price hike of real estate. So RBI will sense that there is improperly high amount of money is going into that market. So to moderate the lending by banks and the associated risks which are there in terms of concentration in a particular area, RBI will indicate that for real estate lending, you need to have a margin of, say, you can only lend up to 75% of loan to value. So this is a prudential measure. Then there was a time when a lot of gold loans were given. So RBI indicated that you cannot give more than 50% of the value of the gold. So, then the third thing they could say is that the risk weight of this has to be 150%, in which case, automatically, because I have to maintain a higher amount of capital, I will ensure that I don't give so much of loans for that particular purpose. So, the mechanism by which RBI influences the direction of credit is what is through selection, credit control through prudential measures. And the last is moral suasion, which is basically a mechanism where RBI has power to give directions, but sometimes RBI does not give directions, but by mere statement that RBI indicates that it is not happy with the excessive lending that is happening to real estate. So this is the statement which RBI governor makes. Then automatically the entire system will tune itself. So here what is happening is RBI, out of its moral authority, is giving a direction in terms of a statement. It is not backed by any power. It is not backed by any circular issued or a notification issued by RBI, but still the market takes cognizance of it and operates in a manner that is appropriate. So these are the various tools which RBI uses for the purpose of influencing the market and ensuring that there is adequate availability of money and credit in the market and availability of credit at an appropriate price. Then the other important tool, so this is another area where RBI is influencing its, keeping of reserves with a view to securing monetary stability. So here the Reserve Bank's balance sheet basically is liabilities is notes in circulation, then assets will be gold coin, foreign securities, rupee coin and rupee securities. So this is the balance sheet of the issue department of Reserve Bank of India. So to adjust the notes in circulation, RBI will make changes in the foreign securities, changes in the rupee securities, etc. So the dollar rupee swaps, market stabilization scheme, then repo rate and reverse repo rate. These are all mechanisms through which RBI is influencing the monetary policy operation. So these are the monetary policy tools and the ways in which they operate. Now, just a few bits about the important provisions that are there as far as the monetary policy is concerned. So first, the method of monetary policy operation is what is called as inflation targeting. So what is inflation? Inflation is the general level of rise of prices. And basically, what is the index that is used for identifying the prices? You have a wholesale price index, you have consumer price index, etc. The Act says that consumer price index will be the index which will be taken into account for the purpose of inflation targeting. And what is the inflation target? It is the desired level of inflation to be achieved by Reserve Bank of India. And who decides it? It is decided and notified in the official gazette by central government. He consults the Reserve Bank. The government consults the Reserve Bank of India, and this target is specified once in 5 years. So ever since we started, we have been having the inflation target at 4%. So presently for 2021, 22 to 26 also, we have the same target of 4%. But it's not a fixed target, but there is a cushion that is provided, which is called as tolerance limit. So the tolerance limit is for plus or minus 2%. So RBI is supposed to ensure that the inflation is between 2% and 6%. And you will be seeing that presently the inflation rate is something like 6.8 or 7%. So the objective of Reserve Bank of India is to keep the inflation within that band. Now, who decides the policy rate so that the inflation is kept within that band? The committee called the Monetary Policy Committee is to be constituted, and that committee will decide. Prior to 2016, it was the Reserve Bank of India's governor who used to decide. Then it is not that they were not adopting a committee approach, but they had a committee called the Technical Advisory Committee for Monetary Policy, and this was basically a recommendatory body, and their decision was not binding on the government or on the governor or the Reserve Bank of India. But there is a change in terms of the monetary policy. This policy committee is a 6-member committee where the governor is the chairman. Then Deputy Governor, Reserve Bank of India, who is in charge of the monetary policy, will be the second person. The third person is generally the executive director, who is in charge of the monetary policy. These three will be RBI representatives in the monetary policy committee. Then 3 officials appointed by central government will be the other 3 persons, who are generally people who are well versed in economics, finance, etc. Presently, I think one person is from IGIDR, that is Indira Gandhi Institute of Developmental Research. Then one is from they're from IIM and another such institution. So basically, economists of repute are the persons who are there in this committee. So the committee will decide the policy rate. And what is the policy rate? It is the repo rate that is indicated. So this policy rate will be the rate which will be used for achieving the inflation target. And the decision in respect of what should be the policy rate will be made by the Monetary Policy Committee. And this decision is binding on RBI. So if the committee decides that the repo rate has to be increased, RBI has no choice but to increase the rate. If the committee says you reduce the rate, then RBI has no choice but to reduce the rate. Then the policy rate is the rate for repurchase transactions that will be specified, and presently the rate is 4.9%. So RBI will appoint a secretary for Monetary Policy Committee who will be functioning, basically providing them with the secretarial assistance. So this provision is relating to how will the members be selected. So for those 3 members from central government, there will be a search and selection committee where cabinet secretary will be the chairperson, RBI governor or deputy governor nominated by him will be the second person, then the Secretary, Department of Economic Affairs, Government of India. Then again here there are 3 persons who are experts in finance, economics, banking, etc., who will be there. And these people will sit together and decide and give the names to government for being appointed, for the appointment of those 3 persons in the Monetary Policy Committee. Then on the recommendation of this search and selection committee, central government picks the persons and appoints them as Monetary Policy Committee members, and the age is not more than 70%. And there are certain disqualifications also provided for there. The tenure of the Monetary Policy Committee members is 4 years. Those 3 members appointed by central government, then the terms and conditions are as decided by central government, and the disqualifications are provided for. Then basically the inputs in terms of information that is required for decision making is supposed to be furnished by Reserve Bank of India. And whenever the MPC asks for any particular information, the secretary has to provide the information, and they have to provide data, models, and analysis which is required for by any other member. Then the only thing is where the name of the entity or a person, that should not be disclosed to the Monetary Policy Committee. Otherwise, all the information needs to be provided for them. Then what is the frequency of meeting? There should be at least 4 meetings, and in India we have 6 monetary policy announcements on a bi-monthly basis. So generally all these will be preceded by a Monetary Policy Committee meeting. So at least 6 meetings happen per year. The schedule is supposed to be published beforehand. Then the quorum for the meeting will be 4 members including. So of the 6 members, there have to be 4 members, which should invariably include the governor or the deputy governor in charge of the monetary policy. And the committee meeting is presided by the governor, and any decision in terms of what should be done in terms of the repo rate will be decided by a vote, and each member has a single vote. And because there are 6 members, if there is a tie, then the casting vote will be there to the governor, and ultimately that will be the basis for resolving the issue. Then the resolution of the Monetary Policy Committee and the vote recorded by each member has to be with reasons. It is not merely saying that you increase or decrease, why you are increasing or why you are indicating that you want to decrease, and by what extent they will have to give this disclosure. This is a mechanism for improving the transparency. Then how does central government communicate? Central government may communicate its views in writing. In fact, there was an issue where the central government called the Monetary Policy Committee meeting and the RBI members separately in 2 meetings. Then Urjit Patel and others, and even the Monetary Policy Committee members who are appointed by central government said that this is not an appropriate mechanism. We are independent. The only mechanism through which the government can communicate its views is by writing to the Monetary Policy Committee. That's all. They cannot call them for a meeting and influence them. Okay. Then procedure of the meetings of monetary policy, etc., is supposed to be decided by regulations. Then transparency in terms of the meetings is on the day the monetary policy is announced. What is the resolution that has been adopted by the Monetary Policy Committee has to be disclosed. What is the voting? Then 14 days after the meeting of the monetary policy statement is there, you have to give a public, press release is supposed to be given where the resolution that is adopted by the Monetary Policy Committee is given. Then what is the vote recorded by each member, and a statement by the member indicating why he has recommended that and voted in the manner in which he has voted. Then apart from this, there is a monetary policy report which is supposed to be given. The other important mechanism of ensuring accountability and transparency is that the band of inflation that is supposed to be maintained is between 2 to 6%, with the target being 4%. So if it overshoots 6% and it continues to be so for 3 quarters, or it is below 2% and continues to be so for 3 continuous quarters, then RBI is supposed to give a report to central government about why they were not in a position to maintain the inflation within the band, what remedial action they propose to take, and the period within which they are going to achieve the target. So this mechanism is going to ensure that the transparency and accountability insofar as monetary policy operation is there. In fact, we had an instance where the monetary policy we didn't meet, but government indicated saying that the inflation figures are not very reliable, so we don't need to think that the inflation has overshot. So when they said that we don't think that the inflation is beyond the 6% level for 3 quarters, then RBI also silently did not submit a report. So that's how the position is in relation to the monetary policy. So with this, we complete the position relating to this. What is this? Monetary policy tools and the functions of Reserve Bank of India.